Welcome to the Transparent FX Academy. I'm Nick and I'm a top podder on TradingView with over 190k reputation points. In this video, I will be speaking about a secret EURUSD pattern that just happened a few weeks ago and tends to happen over and over again. Now, as usual, to keep the video as educational as possible, I will be breaking down this tutorial into 4 major points. First, we will be speaking about the psychology of the pattern. Then we will be speaking about the manipulations that happen inside of this pattern, so stop hunting and those kind of things. Then we will be speaking about how institutions use that pattern to position themselves. So we will be looking at the COT data, which is essentially the orders of institutions, and we will be taking this real market example of the pattern. And then obviously we will be speaking about how we could potentially take advantage of this pattern and integrate it into a strategy. So without further ado, let's get straight into the video. Okay, so let's start from the psychology of the pattern. So how is this pattern created? Now, first of all, we have to keep in mind that all the movements on the market follow a very clear principle. Either buyers are in control or sellers are in control. Now, in this specific case, with this pattern gets created when there is a shift from when sellers are in control and then buyers get into control. Now, there is also the opposite of this pattern, but that is something that we will be speaking about later on in another tutorial. In this specific tutorial, I want to speak about this pattern here. So when you have a situation like the one that is created exactly on this chart. Now, when you see here, let's start from this high, we can see how the market was creating lower lows and lower highs, right? Now, when you have a market which is creating lower lows and lower highs, clearly you have a bearish trend and sellers are in control, right? Because every time that there is a pullback, new sellers come into the market and push the price lower. Now, at a certain point, the market will have to shift from a bearish trend to a bullish trend. And that is exactly when institutions like to create this pattern in order to then invert the trend and shift from a bearish trend to a bullish trend. Now, what they do in most cases is create an accumulation phase in the market, because what you have to keep in mind is that most institutions that have huge orders, at every specific time, they do not have enough liquidity into the market in order to just execute their order by pressing a button like retail traders do, right? Because they have such massive orders that at any specific time, if, for example, they want to buy EURUSD, as you know, in the market, for every buyer, there needs to be a seller, but they have such massive orders that there aren't enough sellers at every specific time for them to just press the button and buy the amount that they want to buy. So what they have to do is to create patterns and take time, potentially also creating manipulations in order to artificially create those sellers so that then they can actually execute their entire order, in this case, buy order for this pattern. And at that point, the market can create the move to the upside. So from a psychological standpoint, this is an inversion from a bearish trend to a bullish trend. Now, what will usually happen is that clearly sellers are in control, and then for the first time, the market fails into creating a lower low. So at that point, we will have a rejection to the upside, and that is when the pattern triggers, because essentially what will happen in this case is a horizontal accumulation, instead of which institutions are taking advantage of every selling order that is entering to the market as much as possible in order to accumulate their long positions. And only at that point, when they have finished their accumulation, at that point, the market can create a move to the upside. Now, what you will also notice is that inside of such pattern that we will later on discuss in more detail, you will see a lot of manipulations happening on lower time frames. So the market creating special patterns, like for example, the usual patterns that the market creates, and then manipulating where usually retail traders will have their stop losses. Now, for example, a very common pattern is, for example, an engulfing pattern, right? So you have the next candle, which is essentially covering the previous candle. So let's go down, for example, on the 4-hour time frame and see what was happening here. What we can see is that we have massive manipulations happening inside of this area. We can see here Many people, when they saw this, for sure, they started longing. What happened after that? The market went lower. And what do most retail traders do? They place their stop losses below the previous lows. And in fact, that is exactly where the market went and manipulated most traders. Again, here we had a massive rejection to the upside. This is a pin bar where most people place their stop losses when there is a pin bar below the low of the pin bar. And in fact, that is exactly where the market went and hunted all those stop losses and then created a rejection to the upside. So we can see multiple manipulations happening inside of this area, which have the only objective of creating artificial selling pressure, because they need that selling pressure in order to actually buy. And why does triggering a stop loss create artificial selling pressure? Because if you have a buy order and you place a stop loss, the triggering of that stop loss is simply a selling order. And that selling order is exactly what they need, because it's that selling pressure that they need in order to fulfill their buy orders. So that is how, from a psychological standpoint, this accumulation pattern is created. Now, we have to speak, obviously, about how we can take advantage of that pattern. But before we speak about it, let's first understand how we can understand when this pattern is creating. So when you have a clear downtrend, which then shifts into a horizontal trend, and we know that at that point, there is a high chance that the market from there will start a continuation to the upside. Well, an easy trick that we can do is check that actually institutions inside of that horizontal area, so inside of that accumulation phase, are actually adding longs. Now, what we can do in order to check that is look at the commitment of traders. So essentially the COT data, which is what the non-commercials, so the biggest speculators in the market, are doing. Now, this is what hedge funds are doing in the market. So the non-commercials are essentially the players in the market that are in the market just for speculation and profit. So that is why it is very interesting to check their orders, because there are also other players in the market, especially the commercials, which have, for example, other reasons for which they might be taking some specific positions. Maybe they have to hedge their orders. Maybe they have to pay employees overseas, so they need to hedge that currency exposure that they have. So it's very important to check precisely the non-commercials, not the commercials. And what we can see here is that during that specific time, which is around here, institutions were showing an increase of their net positions, going from the low at 139k net positions all the way up to 187k net positions. Now, why is this significant? Because it shows how institutions were adding longs and closing shorts on EURUSD during this move, therefore further increasing the probabilities that this is actually a reversal pattern, after which a strong push to the upside could happen, therefore giving us an asymmetric risk to reward for a potential move to the upside and a potential trade. So this is why it is very important to check what institutions are doing, because if you see such a pattern and there is no institutional longing, this could just be sellers losing a bit of their strength, and then anyway more continuation happens. So it's very important for this pattern to actually be complete, to have a clear downtrend. Then you start to see a horizontal movement, inside of which institutions are increasing their net positions, so adding their longs and closing shorts. And at that point, we have good probabilities to having a strong rejection to the upside away from the zone. So this is how you identify the pattern. This is the psychology of the pattern. We also spoke about the manipulations inside of the pattern. We spoke about the institutional positioning inside of the pattern. Now we have to speak about how potentially we could take advantage of this pattern. Well, if you have everything else, so you understand the pattern, you see that it's actually playing out, you see that institutions are adding longs, how you could potentially be using this pattern to your advantage. Well, as for any kind of strategy, you need to set down some very specific rules. The most important type of rules that you can set for any kind of strategy are, first of all, risk management. Let's write them down. So the first important thing that you have to keep in mind is risk management. Now, why is very important? Because when you have a solid risk management strategy, everything else you can essentially adjust it for the maximum potential of the strategy itself. If you don't have risk management, any kind of strategy, even if it works and it is a profitable strategy, anyway, you will make it become unprofitable by not having proper risk management. And now I will go a bit more in detail on that. The second thing is properly backtesting and adjusting the strategy to your own needs and trading personality. But actually, I will put this in this order because that is the order in which I want to speak about it. Because without properly backtesting a strategy, there is no way to actually define a strategy because you're simply guessing. So how you're supposed to be defining your risk management? Well, there are several ways to define risk management. First of all, you could use a way in which you're taking a fixed amount per trade. You could adjust your risk per trade depending on how the losing streak is. There are many different strategies when it comes to that. I really don't want to go in detail in all of those because it pretty much depends from the overall strategy, what kind of losing streak you have. But I want to speak about the major point, in my opinion, for any kind of strategy. This, I would never compromise on it, which is the risk to reward. In my opinion, any kind of strategy needs to have at least a 1 to 3 risk to reward. What does it mean? It means that no matter if you're looking for a long or if you're looking for a short trade, anyway, you have at least a minimum 1 to 3 risk to reward. Now, what does that mean? It means that you are looking to aim at having at least 3 times the amount of pips in your take profit than the ones that you have in your stop loss. Now, why is this important? Because if you're making 3 times what you make with respect to what you lose when you have a winning trade or a losing trade, this gives you the possibility to trade with even only a 30% win rate and still be in profit. In fact, let's take a quick example. Let's take 7 trades, okay? You're risking 1% per trade, for example, which is the usual risk per trade that most traders use, and you lose all 7. At that point, that will be a minus 7% gain, right? So you have minus 7%. However, if you win only 3 trades, so out of 10 trades, you lose 7 and you win 3. Anyway, those 3 trades, since you're making 3 times that, you will actually be at plus 9%, right? So total, you will actually have a plus 2% profit by only being right 3 times out of 10. So that is why I think that not really, I don't want to go in detail, as I said, about how much is your risk per trade, in my opinion, and those kind of things, because pretty much depends from the strategy. I really would recommend to always have at least a 1 to 3 risk to reward for this very specific reason. The second thing is, once you have defined your risk management, and you can change that depending on what you will actually end up having with the strategy, but at least you're supposed to have an idea. You have to go and backtest the strategy. So you look at this pattern, you know that in a situation like this, you have a high probability of a move higher. An easy way to start to lay down the rules would be, for example, to go down on lower time frames. So you're looking at the direction from the higher time frames, and then you go down on the lower time frames to actually pinpoint your entry, right? So for example, here on the daily, you have the pattern, and then you go down on the 4-hour time frame, and you have a set of rules that define when you're supposed to be entering. For example, you're waiting for a break of structure, and that is when you're looking for the long with at least a 1 to 3 risk to reward, like, or even more 1 to 4, 1 to 5, the more the better. So in a situation like this, you will obviously have to go in the past, check every time the market created this pattern, and go over and over again to see how this pattern performed with the specific rules in the past. And once you have accumulated all that data, only at that point you could call that a strategy. And for everything, there are always 3 major points that you have to follow. For any kind of strategy that you're developing for your own trading plan and trading strategy, you have to first backtest, then demo trade until you're consistent. And only at that point you could start thinking about potentially going live. Now, if you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website. Here, you have the possibility to gain access to my entire courses with all the rules of the strategies. You also have the possibility to gain access to one-on-one private mentoring, the VIP market breakdowns with the Telegram signals, the C2 data software, which is precisely the one that we used in this tutorial, the trading station software, which puts together everything that you need as a trader all in one interface. And if you continue to scroll lower, you will see that you will have the possibility to join in order to gain automatically access with the email and password that you will create during the checkout process. So I really suggest that you go and check it out at transparentfxtrading.com. The link is also in the description, and I will see you in it. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free analysis, education, and updates for all of you, and I will see you in my next breakdown.